Today, we want to talk about a topic that I think really confuses a lot of people. And clients that come through our office, they run the gamut of being sophisticated to not being very sophisticated. But one of the things that's is often common to them is that some of the buzzwords, the jargon in the industry confuses them. And yet, a lot of people don't want to admit to that. So today, we want to deal with a relatively easy topic, one would think. What's the difference between stocks and bonds? But again, a lot of our clients, they may know they got a portfolio, a retirement account, whatever, and they know they've got stocks or bonds or equities or fixed income or whatever words are being used on the statement, but they're a little unclear as to what they really have. So today, I want to actually interview one of our advisors, Christian Welborn. He's been with us for 5 years and kind of in the financial services industry as an advisor for a grand sum total of about 7 to 8 of those years. But I want to just get a feel from someone other than me as to what is that difference? What are the key components of stocks versus bonds? So I'm just going to start off kind of opening it. I've got, my cheat sheet, all one page, with that question. So Christian,
Yeah,
what's the key difference between stocks and bonds?
good question. Stocks are interest and ownership in a company, both the present value and the future value of the revenue and profits are generated. Bonds, on the other hand, are loans. You've lent money to a government or a corporation.
And I thought you were going to start off with a joke and say, well, they're both pieces of paper. They are, though, aren't they?
Well, they were, and now they're more digitalized.
Okay.
But if you have one of those pieces of paper, hang it up, give it to grandchild.
Okay. But I guess they are contracts, right? There's a deal being made.
Correct. They're both contracts. They differ in key ways, but they are fundamentally contracts.
Okay, so let's take stocks first. What's the contract? What's the deal if I buy a stock and I don't know who you want to pick on today. Should we pick on Ford or Boeing or whoever? But
Ford.
Boeing. If I buy Ford stock, what's the deal? What's this piece of paper or this digital thing saying?
If you buy a stock, you're a part owner in the company. You and 3,000 of your closest friends all own a part of Ford. That means you own an interest in future revenues, profits, and losses. The contract there is you don't get a guarantee as to what return you will get in the future. The guarantee is you will get a ownership share of those returns or losses.
Okay. Now, I also own part of the company, right?
Correct.
So I literally own a part of the laptops, the desks, the chairs, and all the offices, the equipment, et cetera, right?
Yep, the pens, the paper, the printers.
But I don't get to just walk in and say I need a laptop and I take my representative share.
No.
The contract doesn't go that far.
If it did, it wouldn't be much left.
Okay. Yeah, probably true. Okay, bond then. What's the contract of the bond? What is that piece of paper?
That contract there is you've given government corporation money for a loan, which they hopefully will use to generate more revenue or profit in the future. In return, you don't get an interest in that profit, but you get a guaranteed stream of income and the money back at the end of your term. Think of a mortgage. You give the bank mortgage company money, you pay on principal and interest. You keep the house.
Okay. So in the case of the bond, I'm going to give, picking on Ford, I'm going to give Ford $1,000. And what's the stream of income that I'm going to get?
The stream of income is going to be made up of interest payments or coupon payments, as they're sometimes called.
Okay. And what will they be?
Well, that depends on a number of factors.
Such
The market will dictate what an appropriate interest rate or coupon rate is for a given company based on their credit worthiness, how long the company wants to use your money for. The shorter the term, the sooner you get your money back, the less risk is perceived to be there. The longer the bond, the greater the risk there is perceived to be, and higher reward or higher risk premium is given to you.
So, okay, so how many bonds could a company like Ford have?
There's no legal or limit. They can have as many as they want. Often they give out lots of different batches of bonds. Some bonds they issue solely to pay off or call other bonds that they issued at higher interest rates in order to reduce their income.
So I'm lending money, if I'm buying a bond, I'm lending money to Ford today, but you come along and you want to lend money to Ford 6 months from now, and those two deals could be different.
They be very
based on whether I'm lending the money for, let's say, a year or 2 years, and you're willing to lend the money for, let's say, 10 or 15 years.
Correct.
Sure. Can we make any generalizations about what the difference in that interest would be if I'm lending for 2 years and you're lending for 15 years?
Yeah. Generally speaking, the longer you lend money, the higher your interest because you have to be compensated for the increased time that you don't get to use your money.
Okay.
That doesn't always hold true, and that's layers of complication that we can get into a different video. But generally speaking, that's the trend line.
All right. So we used $1,000 as an example. So I got $1,000 and I buy stock in Ford. So I give them the $1,000 and I get this piece of paper or this digital thing that says I got $1,000 of ownership in Ford. Is that value constant?
No, that'll fluctuate day to day. Sometimes depending on the company and what type of asset class or industry it's in, it'll be small fluctuations. Other cases, it'll be large fluctuations. That's the risk inherent in the short term with stocks.
Okay. So you used the example though of a mortgage as one of these things on the bond side. So the value of my bond constant? I lend money to Ford by buying the bond. It's $1,000. I got $1,000 bond. Do I know that my bond is worth $1,000 at all times?
If you hold the bond to maturity or when the loan is up, you will get all the coupon payments and you'll get your principal back. If you want to sell it before then, what's called the secondary market, that's where there might be some volatility, ups and downs in that bond price. For example, let's say 2020, interest rates are low. You're Ford, you borrow money from me at 2%.
Okay, I'm buying a bond, which has got a coupon of 2%. So
2 years later, 2024, interest rates have gone up a bit more. That same bond is now worth less because if I were to buy that bond from you in the secondary market, why would I pay you the same price when I can take it and get 4%? So in order for you to convince me to buy your 2% bond when I can get a new shiny 4% bond, you'll offer a discount so that all else being equal, I'll make the same money either way.
So interest rate movements in the overall economy or whatever the Fed is doing are going to influence the value of my bond.
Correct.
Interesting. So stocks are being influenced by profits, do you think you said?
Profits, revenues, forecasts of individual investors.
From Ford.
Correct.
Whereas, assuming Ford doesn't go out of business, the value of the bond is being influenced by something totally extraneous, the interest rate environment.
Correct.
Okay.
Again, though, if you hold to maturity, you can escape that volatility with a bond.
Okay. So let's assume I now fully understand the difference between stocks and bonds, but I've still got this portfolio and I want to do something and I want to make sure I'm ready for retirement. How do I determine how many stocks to have and how many bonds to have?
That's a great question. Services seems pretty easy. In reality, it depends on a number of different factors, depends on each individual or household's unique circumstances, what their goals, what their needs are, what their time horizon is, which is how long you have until you need that money for retirement income or to buy a house or whatever the goal may be, and what your risk tolerance is, or what's your appetite for the ups and downs in the market. When you combine these two building blocks, stocks and bonds, stocks act as the long-term generators and engines of growth.
Okay.
Although in the short term, there's volatility or risk, another way to call it. Bonds, on the other hand, can act as the shock absorbers for your portfolio. They can absorb some of the hit and reduce the overall losses or ups and downs in your portfolio at the cost of not generating the same long-term gains as the stocks will.
I've heard it said that the time frame of how long you're putting this portfolio together also influences how many stocks and how many bonds that you're going to have in that portfolio. Tell us a little bit about that. Why? Why is the time frame going to, everything else being the same? I mean, you've told about different rates of return and the coupons and all that, but why is time frame an issue here?
So depending on what time we're looking at, throughout history, I believe the one study showed all the way since 1891, stocks, if held for a long enough period of time, will generate a positive return net of inflation.
Okay.
If you have a long enough period of time to hold on to that money or to keep it invested, the probability of you having a total positive return goes up and up and up the longer your holding period. Again, there's no predictability. You can't forecast. There's no guarantees in the short run. Over the long run is when we can see trend lines produce where averages will be realized and we can have expectations and predictability.
What would a difference, what do you mean by timeline? What is short term versus long term? When does this predictability kick in? What's long term?
Anywhere between 10 to 17 years or more.
Okay. So if I'm investing for, let's say, just 8 or 9 years, I'm going to do what in terms of counting on a certain average rate of return?
Again, depends on your risk tolerance, but you would probably, in that scenario, all else being equal, have a bit more bonds than equities or stocks to get more predictability in your results.
Okay. Whereas if I'm saying this is the kids' college fund, or this is my retirement fund 30 years down the line, I could afford to have more in stocks.
Correct. Conventional wisdom would say you have more time to make up any losses before you need that money.
In that sense, then, are all stocks the same?
No, all stocks.
And I don't mean by company.
Yeah.
I don't mean Ford versus Boeing, but are they just generally stocks or stocks?
Within any given company, there are a few different types of stocks that can be offered. Most common two are common stock and preferred stock.
I've also heard though terminology such as large cap growth, large cap value, or small cap or international as different types of stocks.
Correct. Well, those are different categories of companies or stocks.
Okay. And are they all going to act the same?
No, they're not.
Even over that 17 to 20 years?
Nope. They all have different characteristics because they're different types of companies, different type of industries, different sectors. Let's make it a concrete example. Large cap growth stock would be Apple or Google.
Okay.
Large cap value stock would be McDonald's or Coca-Cola. The businesses that McDonald's and Apple are in, even though they both sound like food, are very different. One does technology, hardware, computers. The other one serves consumers food and entertainment and owns a bunch of real estate. You wouldn't expect those two very different sectors to have similar risk, similar performance, and similar expectations because they are, in fact, different. The cash flows are different. Their risk susceptibilities, different economic and market environments are different. They are very different sectors or asset classes within the overall umbrella that is stocks.
Okay, so large cap growth, large cap value, there's the small cap, international.
International developed, international emerging.
Okay, so we've got 4 or 5 stock categories there.
Yes.
On the bond side, you get the same 4 or 5 or 6, or?
Generally speaking, you have long-term, short-term, and intermediate-term bonds.
So why do we define the bonds that way?
Because the length of maturity, the length that you've lent money to someone, influences the risk of them not paying you back, or the risk that inflation will take off during that time period. And your 5% fixed bond, which sounded like a great deal at the time, sounds like less of a great deal at the time 10 years down the road.
Interesting. So there must be greater volatility in one type of bond than in the other.
There generally is. But it also comes down to what's the creditworthiness of the company offering it.
Okay.
What are the payment terms? Some bonds give semi-annual or quarterly payments. Other bonds give you no payments until the end, otherwise called a zero coupon bond. There's layers of complexity here. There's a lot of different offerings that companies use when they're issuing bonds to fit their needs, but also to meet investor or bond investor expectations and demands.
So I guess what you're saying is I shouldn't really look at stocks as being risky as a category and bonds being safe as a category. Because I think what you're saying is that it depends on the type of stock, the length of time, and it depends on the type of bond and the length of time there in determining which one's going to be more volatile and which one's going to be less volatile.
Correct.
So this actually gets pretty complicated in terms of understanding how much to own of each, right? So even if we're at the point of understanding, I'm looking at my statement and I know stocks and equities are the same thing, and I know that fixed income and bonds are the same thing, that doesn't necessarily get me to the point of knowing easily how much I'm going to have of each, or even what types of stocks, what type of bonds I want, or the sectors that I want to be in.
Correct.
Well, it sounds like that would probably be another video. Kind of dove into how we choose stocks, how we choose bonds.
It does. I think we've taken up enough time right now.
You can't wrap that up in like 10 seconds or something.
Not without doing it the
right.
justice it deserves.
Okay. Well, listen, thanks for listening. We will definitely follow up with another video and kind of explore how we choose bonds, how we choose stocks, and how it fits into your portfolio.